This week, we're joined by Martin North, founder of Digital Finance Analytics and one of Australia's most respected property data analysts. We're going to have a chat about the great intergenerational wealth tsunami. With property now worth over a staggering $11 trillion in Australia, Martin unpacks how this python swallowing an elephant moment is reshaping housing demand, credit access and economic inequality across Australia and the UK. We dig into the shifting sands of what happens when $6 trillion or more in wealth changes hands, asking, is this real wealth? And what does it mean for our property market? Martin challenges conventional thinking on the bank of mum and dad, reverse mortgages, and whether downsizing is a dream or a delusion. If you're wondering how this generational power shift will impact your property strategy, financial future, or family dynamics, then this episode is for you.
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
Hi, I'm Chris Bates, mortgage broker, currently ranked number 3 in the MPA Top 100 Mortgage Broker Awards. Before we get started, everything we talk about today is not personal advice, and we recommend you engage the services of a licensed and experienced professional.
Our guest today is Martin North, someone we're honoured to call a friend of the show. We don't always see eye to eye with Martin, but we do share one crucial thing, a desire for people to make better property decisions and do all that we can to help. Now, Martin is a rare commentator who straddles both the macro and the micro through his deep understanding of financial systems and individual conversations at the coalface. And his latest surveys reveal startling insights into who's riding the wealth train and who's being left behind. So, Martin, it's really great to see you again. We thank you so much for joining us.
Well, it's great to be back. And look, this is a really, really important conversation. And it's one that I think is not being covered, particularly in the mainstream media, very well. And I'll make an initial point here. I have one-to-one conversations with a lot of people about what they're trying to do, not from a financial advice perspective, but from a general conversation perspective. And it amazed me over the last 6 to 12 months how many times this question of the intergenerational wealth problem came up. So I think this is a real issue. And so let's try and get into some of the real data here. And of course, because I'm also surveying now in the UK, as well as Australia, what we can do is we can compare and contrast the differences in these two different parts of the world, because there are some similarities, but there are also some quite significant differences, not least to do with tax and the way that tax is treated, particularly in the UK. And again, this isn't tax advice, this isn't financial advice, but it's a general observation about what it means to the property elephant when it's being swallowed by a python, effectively, and this is a very lumpy, large elephant stuck in the middle of the python. It's going through the generations, and the question is, what's going to happen?
Martin, I love how you haven't even waited for a question. You've just gone straight into basically answering the question without me even asking it. So you're like a bit telepathic here. I mean, that was going to be my question, right? I mean, how is this a python swallowing an elephant, which you've sort of mentioned? And obviously that links into our podcast, right? The elephant in the room here. But, it is a bit unprecedented. And the amount of wealth that we've built, particularly over the last, say, 30, 40 years. And typically in Australia, let's talk, in residential property, it's where the majority of the family wealth is held. I mean, why do you think this is just such a big topic that isn't getting covered? And why do you think it really needs to be thought about very deeply?
Well, there's a couple of data points here. The first is if you look at home price changes from, let's say, the year 2000, in average, in Australia, it's nearly 400% up from the year 2000, right? In the UK, it's about 251% up from where it was in. So in other words, 2.5 times, 4 times. So we've seen a massive acceleration of home prices over a couple of generations. So that's the first point. So, it's big, and it's, we can ask the question why, perhaps as we're going to the show. The second point is that when you actually look at this and you say, okay, so what are the consequences of that? Well, it's $11+ trillion in Australia in the property sector, right? That's houses and apartments and investment properties, right? Compare that with about 4 trillion within superannuation and around 2.5 trillion in the stock market. So this is by far the biggest asset pool anywhere. And what it means is a lot of people are sitting on, big, at least paper gains on their property. But the really interesting point here is when you start looking at this, it's not equally distributed. So when you actually start looking at where is that wealth actually sitting, the truth is a lot of it's sitting amongst older households. A lot of those bought when properties were, 3 times income being the typical mortgage. Now it's what, eight times in some cases. So people were able to get in more easily. And quite often it was on a single income rather than 2 incomes and 2 full-time incomes now. So we've got this situation where, because of the developments in the property market, this bubble of value is sitting not uniformly spread, but actually in particular households' balance sheets. Now, when you start looking in more detail, it's quite similar in the UK. It's just not quite as excessive, but it's still very large. But a lot of these households are now getting to the point of moving into retirement, and in fact, beyond retirement, which then begs the question, what happens? What happens when ultimately people fall off the perch? Or what happens when people decide that it's time to downsize and to move into smaller property? And what does this also mean for those first-time buyers who are trying to get into the market as prices are walking further away from them? And even with the interest rate cuts, if you look at affordability versus buying a property, it's more adverse than it's been for a generation or two. So to what extent does that intergenerational wealth then come into play, either via the bank of mum and dad, or indeed you wait until people fall off the perch and then you get an inheritance? And there was a very interesting piece of research from the Productivity Commission who showed that there's about 6 trillion of intergenerational wealth incoming over the next years. And other people who've done work on this in the wealth management area, it's just even a bigger number. So what does it mean? And where is that going to go? And does that mean that more people will be able to access the property market because of the intergenerational wealth? Or does it actually distort the market even more? Because the question really is an interesting one. Where does that intergenerational wealth go?
Before we get into that, I just want to actually ask you a little question. So when we look at the combined value of the share market, superannuation balances, and commercial real estate, that's roughly a bit over 8 trillion, and versus 11 trillion in residential real estate. So that's sort of, that also that throwing that additional asset class in there even exacerbates the point, right? But are we double dipping with the superannuation total? Because isn't a fair proportion of that superannuation money invested into the Australian stock market?
Well, yes, some is. I agree. And, can you actually create a Venn diagram?
Yeah.
But if you actually were to do that, then actually it makes the property story even more extreme.
Exactly. It makes
right?
it worse, right?
Yes, exactly. And you could argue, well, but there will be some superannuation in property, and that's true, though it's a relatively small proportion. So I mean, these aren't clean figures, but you can see the relativity in terms of what's happened, right? And the fact is that we've got this massive asset bubble sitting in property. Now, I say it's an asset bubble because if I've had this conversation for a long, long time. If you look at long-term trends and relative to, income levels and property, the gap between affordability and property prices is more extreme than it's ever been. And of course, a lot of the government announcements recently, Labor coming back into power, of course, again, will exacerbate it further, particularly enabling first-time buyers to get in, and interest rates are coming down. So the chances are we're going to see property prices going even higher. The question is, what does this do to the overall situation? And my point is, there's a lot of focus on the first-time buyer part of the conversation, but this intergenerational wealth, massive wave that's coming, to my mind, is going to actually put potentially another rocket under property too.
I mean, I think this is and I think that we can get lost in the big numbers, right? $6 trillion. But I think you've got to almost just start to think through, where is that money held? And you're right, it's 60, 70, 80-year-olds, 90-year-olds. And, it's often in their home, and maybe they've got a few investment properties they bought 20, 30 years ago that are paid off, and they're living quite cheaply. They've grown up in a generation and the house is paid off. And so they're just almost accruing more wealth. They don't need to sell down their assets, and they're just going to pass them down on death, a lot of that generation. And particularly if one, it's a couple at 65. When I was back in the advice days, I remember seeing some stats that if a couple got to 65, there was a 50% chance that one of the surviving partners would make it to 92. And so like you actually, people are living a lot longer. And then when they do die, you got to think, well, what happens? Do they give it, if they have kids when they were 30 and they're in their 90s, well, the kids are probably, circa 60 retirement. Maybe they've done all right themselves off property. And so what do they do with the money? Do they pay off their mortgages? If their mortgages are already paid off, do they then just give it to their kids? And then what do they do with it? Do they then re-leverage it? And I think it really is creating our haves and have-nots though, Martin, because it's just enormous amounts of money. If it's a house in the eastern suburbs of Sydney, you might be selling at $5 million, and then that gets split between two grandkids, or it's now giving them $2 million deposits for their home, and then they go and borrow $2 million on that. So is that how you sort of see this playing out? Is that because particularly a lot of the wealth is tied up in the inner city, capital cities, that it'll then just flow back into those suburbs because the kids and the grandkids kind of want to live where they grew up, and it's just going to, create that cycle?
Yeah, I think there's a very significant couple of data points. The first is if you look at the data, around 82% of inheritance by value lands on people who are over 50. So the bulk of it is handing down to kids, right? So it's not coming down necessarily directly to the 20-year-olds and the 30-year-olds who are trying to get into the property market. So that's the first point. The second point is when you talk to people who are getting into that sort of next stage of life, so they've retired and their incomes are perhaps a little bit more compressed than they were, but they want to stay where they are. They don't want to move into other areas where they don't know anybody. And so they're sitting in these large properties. And in some cases, what they're trying to do is to downsize within the area that they know. But that's really difficult because quite often they're living in large properties, perhaps properties that are actually 4 or 5 bedrooms, large plot of land, et cetera, et cetera. But in the same area, there are not smaller properties or even apartments that actually are attractive enough. So you've got a lot of people hanging around in these large properties, right, and not actually moving into smaller properties until they get to the point where perhaps they physically can't manage the property. And in some cases, what they then do is move into retirement facilities of some sort, although I think that's a whole other ball game that we could unravel on another show potentially, because there's a really important trap there.
Yeah, and I do want to touch on that actually, because I think it's to just assume that everybody who owns a house has got all this trapped wealth that they're going to just pass on to their kids is a little bit missing out on something pretty important here. A couple of things there. One is that in a lot of areas, once apartments are built of a substantial enough size for a downsizer to move into in the same area in which they've been living, often they don't get a lot of change. So I think we talked about the myth of downsizing, and so there's not going to be wealth to pass down to the next generation for some time for those downsizers. But there's also, it's quite shocking to when you look at retirement villages and the way in which it's structured to buy into a retirement village and how that really eats away and can completely erode all the wealth that has been, it depends on how long the people live for in these retirement villages, it can completely erode all the wealth that they've actually built up in their family home over decades. Depending on how long they live, there might not be much left at the end of that. So there's other shall we say, players here that are getting a little bit of a mouthful of this intergenerational. It's not an intergenerational wealth transfer. There are actually people that are missing out on inheritances because of that.
I think that's a really important point. And I've had a couple of conversations recently with people who actually some time ago made the decision to go into the retirement context and signed these contracts. And when you look at them and you think, that's madness. What you're doing is you're giving away so much.
Yeah.
You don't necessarily have control about the facilities that you have. And in fact, quite often what they promise to provide isn't what is provided. And in some cases, there's been a transfer of the ownership of the retirement context, whether it's a village or whether it's a particular units, to somebody else, and it's not being run very well. There are huge issues here. The other point about here is some people, of course, are persuaded to do reverse mortgages. So what that means is that what you do is you actually say, okay, I'm going to receive an income from my property. I've paid it off, but I'm going to receive an income. And over time, the value then effectively gets transferred to the provider of the reverse mortgage. And so when you come to actually looking at the estate at the end of the day, suddenly it's a lot smaller than people thought it was. And it's interesting, I had a conversation the other day with some youngsters who'd assumed that their parents were well off. But the only reason that they were well off was because they'd done this reverse mortgage some years ago, and they had zero in terms of net balance available. And that was a complete shock. So it shows you that once you start teasing apart these various elements, there are all sorts of hidden thematics that, again, like I say, aren't being discussed in the mainstream, but need to be discussed because this is such a big and complex issue.
Well, I think the reverse mortgages have definitely gone out of favour. I think it was Brian Hartsoll back in the day was shutting them down and at the banks, and we've had Brian on here, and he also was a company he launched, 2B. I've seen around the traps. Inviva has been doing lots of advertising, and I think they're going to start coming back because, and that's not great for property prices. It's actually, bringing them down. It actually pushes prices up. It means that maybe when you should be selling to free up your cash in your property to support your lifestyle, you just go to the bank and you just get a loan facility and just eat away your equity. And then, you're eating away your inheritance, but you still get to live in the house and you still get to live your lifestyle. And so I think there's one of those things that, if you wanted prices to go down, you wouldn't want reverse mortgages. But I think they're going to start coming up again, particularly as interest rates come back down again. It's not like you're eating away a lot of your mortgage or, you're not going to take in a lot of debt. It does compound though. So it can catch you out. If you live for an extra 20, 30 years, it does get a bit out of it. Yeah. Is that what you're seeing as well, Martin? The appetite to take a reverse mortgage, but different generations have a different attitude of debt, right? So maybe they don't want to take on those reverse mortgages because they were very anti-debt and they wanted to pay their home off as soon as possible. But maybe it's the last straw that they need to take.
Well, it's becoming a matter of least worst option. Remember that most of the reverse mortgages that are sold now are sold that effectively you have lifetime occupancy of the property. So that the provider of the mortgage is basically taking a gamble on how long you're going to live, right? That's what they're actually doing. And so you can only leverage up to a certain proportion of the value of the property over time, but it provides a significant income for some people. But I've always believed that this is something that you need to be really, really careful about. And, sometimes people get into this situation where they're asset rich and cash flow poor. And so this looks like an attractive proposition, but I think people should be very careful. But I agree with you, Chris. There is a very significant wave of this, I think, coming. And there are financial services players who are very keen to reopen this debate.
And it's a bit like on the property side in this SMSF, it's a bit like a lot of property advisors, and I use that term very advisedly with rabbit ears, see that a client or a potential client wants to buy an investment property. They really can't, they don't have the income to support it, but they've got a nice little superannuation balance. And they gritty little mitts on that. And so they can go off and help them buy an investment property in their super fund. And I suspect this there's greedy little pockets out there that would be looking at the equity in a family home and think, okay, well, I'll give you a solution. Really suits me. It'll suit you in the short term. And I think that, our lack of financial literacy as a country is a problem here, because you've got people that really wouldn't have a clue about what they're signing up to and also the ramifications. So, for example, they might not have the opportunity to go into a retirement village of their choice at some future point, for example, because there might not be enough equity left for them to do that. So that really narrows down options in the future. But yeah, it is quite a fascinating idea that there's more and more, I guess, little eyes on this equity that has been built up, right? And you've got an older population owning, I guess, so the proportion of, 11.3, I think is at last count trillion, in terms of total value of residential property according to core logic. What's the proportion of that that's mortgage? It's 21, 22% that has that is debt, and the rest is equity. But you could sort of argue that doesn't really exist, does it? Do you know what I mean?
So two points. If you look at the distribution of the value of property and the mortgages that are actually supporting that property, you see an inverse relationship. In other words, younger households have higher mortgages and little equity, right? On the other hand, if you go up the generations, what you see is a preponderance of much higher value of the property and a falling or zero debt. So it's an asymmetric distribution across the generations, and it's inversely related. So that's the first point. The second is it's not uniformly spread across the country. So if you look, because of course property values are different, compare something out in the bush relative to, for example, the centre of Sydney or Vaucluse or somewhere like that. It's a very different story, and so the value, the theoretical paper value, and I keep saying this, the theoretical paper value of what's there, it is huge. By the way, you don't know what the value of your property is until you actually come to crystallize it, right?
Yeah.
And sometimes people get a nice surprise, but sometimes people also get a nasty surprise. So that's just worth bearing in mind. The third point, though, is that because of this intergenerational wealth conundrum, quite a few younger people are looking over their shoulder at maybe their parents or maybe their grandparents and looking at all that equity thinking, gee, if only I could get my hands on a little bit of that now, that would allow me to get into the property market. And this takes us directly into the question of the bank of mum and dad, or as I've really call it, the family bank, right? Because the family bank is a very active element in this at the moment. And if you've got a lot of equity sitting around in your property and you've got youngsters trying to get into the property market, guess what? There's a conversation which many people are having. Now, whether it's a good conversation or whether it's a right conversation, different story. But this is part of this intergenerational conundrum that we're looking at here. And with youngsters finding it really, really difficult and delaying formation of families, delaying having kids, delaying buying a property by maybe 10 years from where it was a couple of generations ago, then this huge pool of wealth that's sitting out there is like, the light on the hill, as it were. Final point, just quickly. In the superannuation system, people are paying 35 billion plus a year on fees to those in the superannuation system, right? Now, I would argue that we've got precisely the same, another light on the hill from those who are thinking about how, from a financial system perspective, they might be able to profit from this too. And I'm worried that we're going to see more and more and more focus on advice helping people to release some of this equity, right? Or structure in a particular way. I can just see advisors popping up left, right, and center. And again, I'm worried that a lot of people are going to pay a lot of money for stuff that isn't actually necessarily that helpful.
Well, I think the if you think about the next generation, when I remember back in, say 2010s when I was giving advice to clients, and the attitudes around, factoring in your parents' wealth into your financial plan, most clients would say, no, I don't want to do that. It's their money. And, and it's like, well, what I always ask, what's their situation? Are they doing okay? Is there much heritage down the line? And, because it would have a huge impact on your plan. Like if you're, say, for example, 40 or say 45 and you're planning for your retirement, but you're going to get $2 million inheritance because your parents are extremely wealthy, or it's going to be $5 million, then maybe you could take a bit more risk today. But there was always this attitude, though, that I didn't want to include it. And it was a bit morbid to have this conversation, and it would make people feel a bit uncomfortable. But I feel like it's kind of flipped a little bit. I think that, for example, the 20s and 30-year-olds now, they've got a rental crisis. Prices are running on them. They see all their friends getting help from parents and things like that. And so the appetite to ask for help and also the parents' appetite to give help is sort of interconnected, because they don't really want their kids to move away. They can see they've got a rental crisis. They've got a little baby. They want to be close to their grandkids. So do you feel like there has been a bit of a shift where rather than just giving on death, and it's now moved to more like giving while living, and, there's this desire to help while we're still here? And what would maybe been always a conversation that you shouldn't have, it was a sort of not really a PC sort of conversation. Now it's actually just part of the dinner table chat. And people are like, well, no, I really do need your help, mum and dad.
Well, that's quite true. And if you look at my latest surveys on the bank of mum and dad, about half of first-time buyers are getting help from the bank of mum and dad.
Yeah.
Right, which is as high as it's almost been. And the average amount that's being handed across, if you think of the cash element of a transaction, is well over $120,000 now. Higher in Sydney, a little lower in some other areas. So it's quite a big number. And in some cases, it's a lot higher than that. So it is a thing. Unfortunately, quite often these arrangements are informal, and it's not clear whether, in fact, the money that's being handed across is a loan or whether it's actually a gift.
Yeah.
It raises questions about, what happens if parents need help later on? Do you get it back or do you not get it back? What happens if you've got siblings? Do they all get the same access to the same help? And very importantly, of course, the issue of relationship formation and collapse amongst youngsters is also a very interesting thing. So what happens if you get help from the bank of mum and dad, you buy a house together, and then the relationship falters? What happens then? So there's a bunch of very, very significant questions, which again, I think are not being asked, but it is a conversation that's quite often now in play. And because a lot of the older generations are sitting on these huge wealth pools, at least theoretical wealth pools, you can understand perhaps why they feel perhaps not guilty exactly, but they feel they want to help their kids, which is natural. And the kids are trying to get in to form a family, and they can't because they can't afford to. So it's natural to try and find a way through. But I do think there are some traps here. And again, in my conversations, I've had a few people who've been caught out. By the way, I will just tell you one worrying statistic. The risk of default for first-time buyers who actually have got help from the bank of mum and dad in the subsequent 3 years is 3 times worse than normal, because they won't necessarily have saved up. They won't necessarily have had the same discipline in terms of managing their finances. And so, if you get a seagull payment, as I call it, just dropping like that buy a property, what it means is that you actually have less financial discipline, and quite often you can risk getting into more difficulty later. So it's just really important to understand that this is not a simple process. Oh, and by the way, in another conversation that I had some months ago, I was talking to an elderly couple who had actually done the right thing and had actually pulled out equity from their property. They'd remortgaged to be able to provide equity for both of their kids. But unfortunately, their own financial position deteriorated, and they found that they didn't have enough money coming through their own bank accounts for their own longevity. So they actually ultimately had to sell their property and effectively move in with the kids.
I don't know if you've come across this, Martin, but on a number of Facebook groups and places that I stalk periodically, I've actually, I've observed with a bit of distaste, actually, an attitude amongst some people of resentment if their parents don't help them. Yep. As if to say, look, what's wrong with you? Don't you see, that everyone else is doing it, sort of thing, and you've got a house, and I don't understand why you're not helping me. And I've actually been really, really shocked. Are you coming across that?
Absolutely right. Yeah, it's becoming a bit of a right. It's an expectation. Yeah. Everybody else is doing it. Why aren't you doing it?
Yeah, and then if you sort of couple that with this statistic, which is quite alarming, that the risk of default 3 times higher, the rate of default in the first 3 years 3 times higher. That's very scary. But that goes back into financial literacy, doesn't it?
I think the financial literacy question is really important. And by the way, if you do a bank or mum and dad's arrangement, it's really important to formalize it sufficiently to have an agreement so people are clear on whether it's a loan or whether it's not a loan, under what circumstances it would be repaid, et cetera, et cetera. Is there interest being charged, for example, or not? All of those things really need to be discussed. And unfortunately, it's literacy levels are so low here that people often end up just handing money across, or having a very informal, because people don't like talking about this really.
You don't want to get your kids to sign a contract, do you? I mean, it's a little bit weird.
Except this has consequences, right? Now, let me just make one other point. Australia is interesting because there is no wealth tax on death in Australia,
Yeah,
right?
I was going to get to this because this is a
Yeah,
big difference between here and the UK, right? And
yeah,
I'm really
absolutely.
keen to understand what the situation is there now.
Yeah.
I'm on a personal mission to help more people make better property decisions. Most people don't realise that they can cost themselves hundreds of thousands of dollars over the medium to long term when they make property decisions without all of the information that they need. And what I do is help people with tricky real estate problems, which often masquerade as simple questions like, should I sell my investment property because the interest repayments are hurting? Or should I buy before I sell? Or the other way around. You can connect with me and access all of the tools that I've created to help you make better property decisions at veronicamorgan.com.au. And there you will find resources for first home buyers, details about my buyer's agent mentoring program. You can connect with my Sydney-based property management and buyer's agency teams, Australia-wide vendor advocacy, or ask me for introduction to the small group of buyer's agents that I would personally recommend across the country. That's veronicamorgan.com.au.
If you're looking to buy your first home, thinking of upgrading to a new one, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and, importantly, get the finance right. Reach out via my website, alcove.com.au.
So governments around the world are desperate to try and find more tax income, right? Because governments are spending like drunken sailors. Look at the latest GDP numbers. You can see that the Australian economy was supported by mostly government spending, which is now just fading slightly. But it's a real problem. So governments around the world are desperate to try and find additional sources of income. Now, in the UK, there is an inheritance tax or death tax, right? Whichever you want to call it. Basically, there's a certain proportion of assets that on death can be transferred with no tax to a partner, for example. But beyond that, there are limits. And there are limits that, it's a reasonable amount, but not a massive amount. But above that, you can be charged up to half in terms of tax on death. So what it means is when your estate is actually administered, the first proportion will be effectively tax-free. But above that, the state will get half. So you can get round it by moving some assets early, 7 years early, but there are limits on how much you can move and to whom you can move them. So there are already in the UK limits, and this, of course, does have an impact on what people plan to do or don't plan to do. And quite often it leads to horrible conversations on the estate administrative side when there's a huge government impost that nobody actually thought about, right? Now in Australia we don't have that, right? Particularly on the main home, in investment property, of course, you've got the quite issue of capital gains and things. But the interesting question is it something which the government in Australia might start to think about, because they're desperate to find alternative new funding routes. And to my mind, this massive amount that's sitting in the theoretical value of property is something which, looks pretty attractive. So I wonder whether there's, somewhere some skunk work going on thinking about that. By the way, we could also talk about the unrealized capital gains stuff, another strategy, which is, currently in play at the moment. I know that there's a discussion about whether the coalition will support an alternative version of it, et cetera, et cetera. But the point is the government's desperate to try and find other sources of income, right? And to my mind, this massive pool, it's again, the light on the hill. They're going to think about trying to grab some of it.
Well, yeah, although it is something that's used at elections, Liberals love to trot out that the Labor is going to bring in a death tax. So it's very unpalatable in the electorate, especially when you've got, $11 trillion worth of value of property, that would be caught up in that. On this superannuation legislation, which has been proposed, or it's in Parliament at the moment, isn't it? It's this idea of having a tax on unrealised gains, and I know they're saying that 1% of people Australians have got a balance over 3 million, but it's not indexed, so therefore that can come to a point where it could be commonplace. What are your thoughts on that as a policy?
Well, I think it's a disgraceful policy, because the problem is once you open the door to it, okay, it's on superannuation balances. It's 3 million non-inflation adjusted, which means that over the next 20 to 30 years, a greater proportion of people could well be pulled into it. But the problem is that it's on a theoretical movement in the value of your assets. You go from here to here, and then you have to pay tax on a proportion of that. But if it goes down, you don't get a refund. What you do is you have a loss that you hold until subsequent prices go up again. So if you're in the situation where, asset values, for example, share markets took a dive and stayed down for a year, 2 or 3, 4, you would have paid a huge amount of tax potentially on a theoretical value that never actually accumulated. And normally, of course, in Australia, the idea is that what you do is you pay tax on transactions. So you buy and you sell, and if you make a gain in most asset classes, then what you do is actually pay a proportion of the gain in tax. But this is a theoretical, messy way of trying to actually grab more tax. And I worry that it's opening then to a beginning of a wider aperture. Why just in superannuation? Why not out of superannuation? Why not the value of the family home even, if you really wanted to go there? So I think this is a really, really important thing and should be resisted because I believe that it is philosophically very difficult to administer. Yeah. It creates a really large amount of uncertainty in people's finances. And if in fact, for example, if you had the situation where your superannuation balance was 5 million, but it was actually 3 properties and you were forced to pay a significant chunk and you had no cash flow, what do?
You sell one.
Got no choice.
Yeah, forces you to sell down assets.
But that's the whole point, right? So the whole point of this is to take money out of a tax-free environment and for targeting people with big balances in super to take the money out. And so if you tax it on gains, then they'll just keep big balances in there and they just won't sell their assets, right? If you do it on unrealized gains, then you force them to sell their assets, which forces people to take money out of super, which they're kind of trying to reverse the damage that the people who have taken advantage of the system for 20, 30 years, they're trying to say, hang on a sec, we stuffed up. The best way to do this now is to tax on unrealized gains. And, I think that the point of superannuation did get out of control a little bit sometimes for people, and they're getting massive benefits, right? And I think that this is probably the best way to reverse that. Not to say I agree with it, but if I was thinking about policy and I'm saying, hang on a sec, there's a lot of money sitting in here. And yes, they've done things for their retirement. And yes, they're not on the pension and things like that. But you could still not be on the pension and have $3 million in super, right? I think that's why they're doing it, right? That they had to do something that was quite drastic to force people to take money out.
Well, 2 observations. Firstly, the ATO has already warned that if they see people rejigging their affairs to try and actually avoid it, then they're going to look into that quite seriously, right? And the second point is, I would argue that if you want to actually tax superannuation more, then that's fine, but don't go the unrealized capital route, right? Maybe make it more of a wash so that it's less advantageous. I agree that the superannuation system was built on one set of principles, got warped, and there are a relatively small number of people who are massively exploiting the system. Maybe put a cap on the total amount you can hold within superannuation, something like that. But I don't think that we should open the door to unrealized capital gains, because it is too easy, once that precedent has been set, for the government to then say, oh, well, we've done it over there, why don't we do it over here too? And I keep coming back to this massive asset pool, all this property value that we got, this theoretical value that people are sitting on. At some point, I think I'm worried that the government is going to start looking at that thinking, oh, well, we can't just not ignore that, right? Just as they can't ignore the superannuation story.
Well, interestingly enough, because of course the reason that there's so many Australians that have invested in residential properties, because, well, effectively there's 2 things. I would say 2 main reasons. One is obviously the tax, the favourable tax situation, which, and you said earlier about, pinpointing 2000 as a point at which prices really start to rise very, very rapidly in Australia. And you put that down to the Howard government and the change to the capital gains tax discount at that point, I'd say, rather than negative gearing. Yep. And So that's the sort of one thing. But the other thing is that reduction, drastic reduction of government spending in public housing. So someone's had to provide rental accommodation, and I think it's really insidious, and I actually think it's really unfair the way that the government has basically shifted that whole responsibility onto individuals, and now has might have an attitude, or there are there are groups out there with the attitude that those individuals should be in some way punished, for having benefited through this. So it's like, well, yeah, but the government was quite happy to stop investing in public housing. So it is an interesting one, because I think, if you start taxing unrealized gains in property, that's one hell of a way to make sure that nobody wants to invest in property. I mean, you're going to kill that one quickly.
Well, and the interesting question is, do governments want property prices to continue to rise or not? And it's interesting that through the last election, right, both major parties basically gave assurances to the population that, oh, no, we're not going to see property prices fall on our watch, right?
Yeah, exactly right.
There's expectation that prices are going to continue to climb now, sustainably, whatever that means. And I come back to, it's not sustainable now, because if you look at that ratio we talked about earlier on, 8 times income. And by the way, income now means 2 full times income or more relative to what it used to be. You can see how far we've come from a sustainable situation. And look, I don't think property prices will fall, but there's a risk they could fall. If we get a major recession, if we get a major crash, there's still a risk of that. But the fact of the matter is, governments have engineered this. This is bad policy over a generation or two. It's bad policy when they stop social housing and public housing, when what they do is they attract the likes of BlackRock and other international investors to build to rent. That's another flawed strategy in my mind. It's not really going to solve the problem. We've got this massive, strong migration, so there's a very strong demand. There's a lack of supply. We know all those reasons. Governments have stuffed up majorly here. And I would argue that this equity bubble that we're talking about, is it illusory? Is it real? This is a result of this bad policy from government.
Yeah, and you've created a problem that you can't really fix, right? So in the UK, though, you said that since 2000, their property values have gone up 2.5 times, ours has gone up 4 times.
Yep.
What are the major differences? What are the major reasons for that difference?
So 3 things. The first is that the lending standards in the UK were much stronger, particularly post the global financial crisis. Remember that in the UK, they actually had property prices fall about 20% through the global financial crisis. So we went up, down, now it's coming up again. Through that process, they actually put stronger controls on the income multiples that people can borrow at. And they also then, secondly, dialed back the benefits to property investors. So you don't get the same gains and tax support in the UK that you do in Australia. And thirdly, the momentum with regard to construction tailed off later. So there was a little bit more. By the way, they now want to build 1.5 million homes over 5 years. Sounds familiar. They can't get the construction workers to come and build. Cost of construction's too high, and property prices in the UK are still looking as though they're going to go up. But those are some of the reasons. So there was different approach from government in terms of the regulatory environment. With the same problem though with the lack of public housing. So that's another big issue. We've got a very strong demand for the rental sector. So rents are very high in the UK too. The final point there, and it comes back to what I said earlier on, of course, the different taxation around death in the UK does have a dampening impact as well. So people try to manage their affairs a little bit differently and try and, in some cases, pass wealth down earlier than in Australia. So those are some of the factors.
Yeah, so if they're doing that, I guess they're still helping. Yes, so they've still got a bank of mum and dad as well.
Oh, yes. The bank of mum and dad is as strong in the UK as in Australia, about half of transactions for first-time buyers.
So I'm still struggling, other than the tax treatment of investors, I'm sort of struggling to see what's different. And so, but how does that play out in terms of a rental crisis over there? Because, like you say, they've still got pressure on rents, they've got a lack of stock. How are those two things not linked? Property price growth and rental growth obviously not linked as tightly as they are here, or they're not linked in either country, and therefore, the different factors at play.
They're loosely linked only. I believe that the rental story is more associated with income growth than property prices, because it's the people's capacity to pay is the question, right? And if you look at what happens with regards to when you get a spike in income, rents tend to go up.
Yeah.
Martin, I think with this actual wealth in Australia, though, I know it's a bit of a paper number, right? But do you think that it'll actually materialize and will actually be passed down generations as cash, right? Because, if, for example, I guess when I was looking back 10 years ago, maybe even longer, I was thinking, oh, God, all these people are going to die at some point and they're all going to sell their properties and all that wealth's going to come down. But the reality is, right, it's at the margins, right? Our turnover rate of property.
Die on the same day.
That's right. And we all live long, and there's no real solution for them. I guess we're getting to a multi-generational family more than ever, right? And and people are sort of younger people haven't got the house, so they need a house for Christmas and families, and they go to their parents and their grandma's house for that, and so it's kind of like there's a lot of reasons why they don't downsize. Tax-free growth, it stops them getting the pension if they sell, for example. And so do you think that that's actually going to materialize just because everyone's living in their houses longer and longer, right? So the turnover rate of properties, reducing quite a lot, right? We used to live in for 7 years, now we live 14 years, and that's just getting bought. And I think that's going to keep going. Like, I think the reality of going for an apartment to a house, to a bigger house, to a better house, to a better house, that's just not happening for most people, right? And so they're going to get stuck at level 2 on the ladder, and trying to climb it 3 or 4 more steps isn't going to happen. So you're going to see this world, and I think you can see for the last 15 years that is the amount of listings as a percentage of properties is actually reducing. And so even though these people are dying finally, and they're living longer and longer, and it is going to get materialized because they're always going to sell it into an undersupplied market. Do you believe that, or do you believe that that it's not ever going to be the numbers people expect?
Well, it goes back to what is the future trajectory of home prices, and like I said, I don't believe that there is much evidence that we're going to see any significant correction in home prices ahead, despite the fact that we're way off kilter. And there is always a risk. Remember I said 20% in the UK. There were areas in the US that fell 40% through the global financial crisis. So there's always that risk in the background. But let's assume that we actually have this steady state or growth in prices over the next 15, 20 years, and I think that's the most likely scenario. It's one of the ones that I run in my scenarios at the moment. In that situation, people are going to come up to these events, which will be life-changing events, whether it's moving, into retirement or whether it's actually, people fall off the perch and you have to deal with it. So the chances are that there will be properties being sold at these prices. And so over time, the value that is theoretically there will be realized. Now, let's understand where that value came from. A lot of it came from mortgages initially. So it was actually, the debt burden was what stoked it initially. And then lack of supply, as you say, Chris, there are not enough properties coming on the market to meet demand. So therefore, people are still paying top dollar plus. And I guess the question will be, will there be enough people of the generations below to be able to buy the property from the generations above? Because if there isn't, then you might well see property prices begin to slide back. If they can still get the money, whether that's via the bank of mum and dad or whether it's by banks lending more, then the property price escalator will continue. And
that elephant will continue going through the gullet of a snake.
Well, I do have this thought, this big bulge is sort of going down the python. The question is, what happens when it hits the end, right? Will it get stuck? Will it get to the point where the python has indigestion? And I don't know. I actually don't know. If you'd asked me 10 or 15 years ago, I would have argued that this was completely unsustainable, and at some point it was going to go pop. Yeah.
That's when we first came across you.
That's what I'm just a bit curious, Martin, because I do think that you've changed your tune a little bit, and that's okay. But there's nothing wrong, right, with changing your beliefs, right? Because we're always taking new data, we're always learning, and that's and it's
I underestimated government's
Yeah.
ability to keep the python swallowing.
To keep,
Mm.
to keep
Well-
extending the length of the python.
I mean, that was the learning for me in COVID, like putting it out there. Like when payment holidays came out on mortgages, I was like, how is that even possible? Like, you know,
Yes.
take money out of super, 10 grand. Like, okay, how is that possible? Like, you know, this 5% deposit scheme coming out now. Like it's you know, whenever there's a fire, they quickly put it on, try to put it out, and then throw even more on to encourage the party to go. So, you know, they've come back with migration, right? Like the post-COVID, you know, open the borders. And so do you think that is that sort of the bigger picture, is that, you know, and together with the interconnectedness with banks, and that they're both in on it and they both are too big to fail, it's those two ingredients that keep supporting prices even no matter what fire comes?
Plus the building and construction sector. That's the third leg of the
capacity,
stool, right?
The capacity restraints.
Yeah. So I think that we've got this one-way perpetual motion machine at the moment, and I don't think that governments have given us any idea that they want to change this. Now, ultimately, you know, the economy gets bigger, banks can lend more, you know, that makes prices go up. That means that people feel more wealthy. That means that people perhaps will spend more, et cetera, et cetera. So you can see how the perpetual motion machine is actually running at the moment.
Flywheel.
I guess I keep, it is. But like I say, I come to this sort of this rather awkward question. What happens when the elephant, you know, gets down towards the back end of the python, right? Can it really go on forever, or will there be an event or events that actually, you know, changes the world? But like I said, I underestimated what the government was prepared to do. I underestimated how much risk the banks were prepared to take. You know, postscript, did you see the Rams news out today? You know, that they're being suggesting that maybe they were lending loans they shouldn't have lent. Funny that. So there is a really important question here about equity and fairness. But let me make one other point. The broader economic issue for Australia is, as more and more of the economic momentum coheres around housing, less and less investment is available for productive purposes like businesses. Sure. No wonder our productivity continues to languish, right? The latest GDP number was very low. The GDP per capita was backwards again. So what we actually have is we've got this housing black hole, to change my analogy from a python, right? And it's sucking more and more into it. But I'm not sure it's economically that sustainable, nor is it economically productive. And that's my problem. So unless we do actually have a change of heart, we're going to have more and more of this sort of wealth sitting in a single asset class. And I don't know about you, but diversification is normally quite sensible, right? And putting more and more of your assets in the property basket worries me.
Yeah. I mean, I absolutely agree around the productivity and the system and the flaws and the problems with it, etc. But I mean, I've been coming into the property bear den with you, Martin, for probably 7 or 8 years, and I always come on, and then all of a sudden the YouTube ticks off, and I get slated, and the keyboard warriors take me. So your cohort, though, that your followers, right? And you built an amazing channel, an amazing community for many years, and education. How are they feeling around this, though? Like, are they feeling more aware of the bigger picture and all the elements to this? Because, you know, a lot of them do focus on, we'll just cut migration, or, you know, it's not good for our economy and productivity, or it's 10 times multiples of income, or, you know, they're just looking for an easy answer that's going to blow it all up. And how are they feeling about it, though? Because are they getting a bit more broader view and going, it's maybe a bit bigger than I thought, and maybe it's not as clear cut as if you change negative gearing, prices are going to go back to affordable levels?
Well, certainly what I try to do on my channel is to have a more sophisticated debate about what's going on, rather than just saying property prices always go up, or it's all going to blow up, right? And
we're going to go down 40%.
I do keep saying, you know, there are different scenarios and different leverage points, and you know, I have been clear in that over the years, right? I've never been, you know, I always get quoted as saying, it's all going to go back, you know, but there are other reasons.
the same thing happened to Louis Christopher, right? In the AB's, in the 60 Minutes thing, like his line got completely misread. And then everyone thinks Louis' saying price is going to fall 40%. Well, no, he didn't. He said that was one of his least likely scenarios.
Yeah,
so
absolutely.
I appreciate you've been also targeted with that, I would say as well.
Correct. No, exactly right. And of course, the headline was always on, it's one little piece. And that's why I always put up multiple scenarios. But what I do think is quite interesting is there's a disconnect that I see quite often, and I have this in my one-to-one conversations too. There's a disconnect between the macro picture, what's good for Australia, what's good for Australians, is property going up good? And then the disconnect between me and my family and my property, right? Because quite often people say, well, actually, I quite like the idea of my property continuing to go up, right? And I quite like the fact that I'm now living in a $3 million or $4 million home, not a $1 million home. And I do recognise that this is a real pressure on younger. So there's a fundamental disconnect, and I think that same disconnect, by the way, lives in political land. Because if you talk to a politician off camera, they will actually concede that property is broken, dramatically broken, right? But they will never say it on camera. They'll, So again, I think we're almost kidding ourselves that we've got this sort of, real view versus, this other view over here. So that's why this is this is a good conversation to have, because it's trying to raise people's awareness. And I'm not saying I know what the answers are, but I think we should be asking some hard questions about this equity pool that's being created, and what are the consequences of that for the next generation? What are the consequences for the property market? And by the way, be a little bit cautious and careful. And when you turn out to be the bank of mum and dad, just think of that through. Don't just sort of jump into it because everybody else is, right? What I'm trying to raise is there are some really deep questions here, and it is worth reflecting on those questions. And also, run the counterfactual, because, you might think X will happen, but what happens if Y happens?
Yeah, that's right. You're getting stuck in the confirmation feedback loop, and you just keep going. You think it's always going to go up, but there's always, you've got to be, staying, changing, taking new information in, which it sounds like you have. I mean, that's why I do rate what Chris Minns is doing from a bravery point of view, because, that was very unpopular. It was against the grain of what state governments have done for a long time. He's coming in, he's like, no, we're going to actually change zoning here. We're going to listen to you, but you know what? We're going ahead. There's no stopping this. And you can see that that's changing, right? It's pretty brave, and he's fighting a good fight, I feel, to at least trying to change the system in a better direction, rather than just going status quo. Mark, can you finish with a dumbo for us? You must have another little story for us, mate.
Well, I've got a little story. It's not a dumbo, but it's really interesting. So I was having a conversation the other day with somebody who's, getting on a bit. And they're thinking about their future, and they've got this property, and they've got this idea of putting a granny flat in the grounds of their property, moving into the granny flat, and then letting their main property. And I thought, that's a very interesting strategy. And I hadn't heard that before, and I thought I'd just share that because I think that's quite fascinating.
And so you bring it up as a dumbo because?
Because traditionally, we would always say, granny flats, not sure that's a good idea. But in this context, it occurred to me that actually maybe it's not such a dumb idea. So
I think this is an interesting space, because the ATO are obviously looking at land tax a lot, or the state governments, right? And you just got to be really careful. Is the property now an investment property, and you're paying land tax? And how big is the granny flat? Is it a quarter of the block, and now you're paying land tax on?
It's got to be below 60 squares.
Yeah, that's right. And then you've got different states. What states this in? Like Victoria, pretty hungry. Maybe you could get away with it in New South Wales. So, are you going to rent it out full time? Was the lifestyle compromise you're going to get? And
also just, can you devalue effectively the whole asset,
your house.
Or you can reduce the caliber or the quality of the asset if you do a really shitty.
I know.
If plonker get a granny flat in the garden, got no garden left, for example.
So maybe they could just go and rent their house out, and then just go rent a granny flat somewhere or something. Like there's sometimes people got so attached to just living on that same block of land, but maybe just cutting ties would be a better thing, and renting something else.
So the dumbo part of it was more, it's fascinating how when people are confronted with these very complex situations, people try and explore it in different ways. And sometimes what I feel is that some of the alternative solutions that are actually being thought about have traps, particularly bear traps, for the unwary. So, in the current environment, again, it's really, really important not just to take the high level view, but really go into it in some detail and think it all through.
Well, get some advice, get some tax advice, because that'd be the big thing I would think would be a massive trap. And I do come across a lot of people who've come up with these novel ideas to solve the problem for their own family. And I often cringe when I think of some of the crazy things that I hear people planning on doing. And I'll ask a few questions, and it's quite clear they have zero interest in really testing whether it's a good idea or not. They've dug their heels in. They've decided that's their solution. So, it's an interesting one, isn't it? That people are coming up with wonderful ideas.
It's a sign of the times.
Good chat always. I know it's 7 a.m. there. I appreciate you getting up early for us, and we hope you have a good day. Enjoy the English summer, and we'll chat again soon.
Enjoyed it. Thank you. Take care. Bye-bye.
It's always lovely to see you, Martin. Thank you.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.